Saving is not enough. Invest your money. Shares and mutual funds. Naveen's brother has just started working a couple of months back. He spends most of his salary on having fun. Naveen's father advises Naveen's brother to start saving for the future. Naveen's brother mentions that he's already saving in the bank account. His father explains that saving in a savings bank account only gives around 4% interest, and this is not enough to beat inflation. There are other avenues of investing, like shares and mutual funds, which give better returns over the long term. Naveen's brother is now interested. He asks his father to tell him more about investing in shares and mutual funds. Naveen's father explains. An equity share or stock means you own part of a company. When you buy a share or a stock, you buy piece of the ownership of the company. Stock prices do not remain constant. They may continuously go up or down. Hence, stocks are considered riskier. Naveen's father recounts an incident in the past. Some friend of his told him about XYZ.com company shares. The shares had been creating a buzz in the markets for a while. Naveen's father put some savings there, and in a week the stock price had crashed. Naveen's father has learnt his lesson the hard way, that people don't know about the research that goes into picking the best stocks. And as individuals, it is very difficult to predict the best performing stocks, and no one sector or stock performs consistently every year. One should have time and information to invest directly in stocks. Hence, mutual funds are a better way to invest into stocks. What is a mutual fund? MF or mutual funds are funds where thousands of people pool in their money, and people who are experts manage the portfolio and invest into financial instruments like stocks, bonds, and other securities, and the returns are in turn shared between the investors. As an investor, you can buy mutual fund units which basically represent your share of holdings in a particular scheme. These units can be purchased or redeemed as needed at the fund's current net asset value or NAV. These NAVs keep fluctuating according to the fund's holdings. All the mutual funds are registered with Securities and Exchange Board of India or SEBI, which is the regulatory authority of mutual funds. Mutual funds offer various benefits such as professional management. Professional money managers manage your money. Liquidity. Mutual funds can be encashed easily. Diversification. Mutual funds provide diversification which helps in reducing the risks of loss since they invest in different stocks for different sectors. Transparency, flexibility, return potential, choice of schemes. There are a whole host of schemes available. Low cost, well-regulated, tax exemptions. Rate of income tax on equity mutual funds is relatively low. There are various types of mutual funds like equity or growth funds, diversified funds, balanced funds, sector funds, index funds, tax-saving funds, debt funds, liquid funds, gilt funds, exchange-traded funds, etc., based on the instruments into which these schemes invest. You may choose the type of fund you wish to invest into based on your goals and time horizon. Naveen's brother was happy to know the advantages of investing in mutual funds and decides to invest into a mutual fund.